Good afternoon. It's Friday, the 26th of April, and welcome to BizTech Asia's Asian Midday Market Watch. I'm Jeffrey Halley, and today we are joined by Kelvin Wong, Senior Market Analyst at OANDA in Singapore. Kelvin, welcome to the show.
Hi. Good to hear from you again, Jeff, and happy Friday to all.
And a happy Friday to you and all our viewers. Let's have a look at Asian stocks around the region today, and then we'll get your thoughts on those initially, Kelvin. Bit of a mixed day here today, to be honest. The Nikkei 225 in Japan is up 1.14%. Shanghai is up 0.87%. Hong Kong's Hang Seng is up 2.07%. With the S&P 200, S&P ASX 200 in Australia slumping by 1.4%. In South Korea, the Kospi is up 1.1%. The Straits Times Index in Singapore is almost unchanged on the day, while Kuala Lumpur's KLSE is up just 0.29%. Kelvin, I know there's probably some tech exuberance amongst those numbers, but quite a mixed day. Can you tell us what your initial thoughts are on those movements today?
Yeah, sure. So it seems to me that it's a rather mixed bag for the across the board for the Asia stock indices or benchmark stock indices. So we see a bit of positive movement on the Hang Seng Index, the HSI, the HSCI, and the Hang Seng Tech Index, primarily driven by better than expected localized earnings in China, in mainland China, that is supporting this ongoing bullish tone on the Hang Seng Index and its respective Hang Seng indices, the rest of the board, since the start of this week. So very interestingly over here is that those markets that are heavily related to AI semiconductor play has been performing very well as well for today's Asia session. Typically the Korea Kospi and the Taiwan TAIEX. All these came in line with better than expected AI team related play on the US major big tech names at early Asia session today, where Google/Alphabet and as well as Microsoft managed to actually beat earnings expectation and also give a kind of a rather, I would say, a rosy revenue guidance in their business line going forward in the next quarter. So that actually explains this heavily tech concentrated stock indices that's actually outperforming the region right now.
Let's talk about Japan today, which has been the main highlight for the Asian session, and there's been a few surprises out already today. First of all, we saw Tokyo's year-on-year CPI plummet to 1.8%, and that is well below the consensus of 2.6%. We've missed it by almost 1%. That's been followed a few hours later by an unchanged Bank of Japan. But that Tokyo CPI today, is that going to change the Bank of Japan's future outlook? And what are your thoughts on the nuances, the nuts and bolts of the Bank of Japan decision today?
Sure. So I think we got to take things one step at a time. So if you look at the release of today's Tokyo CPI data, is pretty much shocking because of that 1.8% year-on-year deceleration in the month of March. So that's a kind of an outlier. So bearing in mind that, do not forget, in the last 3 to 4 weeks or so, we have several Bank of Japan officials sounding rather confident that the inflation trend in Japan is going to be around 2% or 2% plus, meeting BOJ target after years of deflationary risk environment. So with this shocking Tokyo CPI number, Tokyo CPI data that is out today's morning, that could actually potentially change the mindset of BOJ officials by looking at the outlook report that was actually released today together with the monetary policy decision, which is pretty much expected no change. But initially, ahead of today's release of the latest economic outlook report, market participants are expecting actually a slight upgrade on their median projected fiscal year inflation outlook for Japan. So that's fiscal year this year, which is 2024, and fiscal year 2025, a slight upgrade to 2% from 1.9%. But this time around, they remain stamped at 1.9%. But what's interesting over here is that in the longer term perspective, the fiscal year 2026 outlook is being projected at 2.1%. So it seems to me that in the thinking of BOJ officials, they are still pretty much confident in a longer term basis that Bank of Japan is still able to actually hit their long run inflation target at 2%, given this more sustainable wages growth that is actually being much more of a rosy outlook given the latest round of wage negotiation that came in better than expected. So I believe that with that in mind, they actually have that confidence of Japan, the Japanese economy hitting that 2% target from a longer term perspective. But right now, from a shorter term perspective, given this kind of a soft number, at this point in time, it could actually add pressure for the Japanese yen to actually trade lower against the dollar, which is pretty much evident right now. Based on the current price action of the dollar is now actually the dollar yen is way past above 155.70. So that was the high made during the US session overnight yesterday. So market participant right now will be pretty much paying very close attention to Bank of Japan Governor Yuda press conference that will be out later in about 1.5 hour time. The closure of the Japan stock market session, to quiz him about him that what's his view on the current Tokyo soft CPI number? Is it a trend that he is watching closely, or does he believe that it's just an outlier, a kind of a blip, just a kind of a negative shock, whereas the longer term inflationary trend picture is still on the uptick in Japan. So something market participants will be paying closer attention to. But do not forget over here is that the fundamentals right now, at least in the shorter term perspective, is actually more supporting of a yen weakness rather than the yen strength, given that growing US Treasury yield premium widening against the 10-year and the 2-year GDP yield after what we witnessed yesterday's much more hotter than expected Q1 PCE data out from US.
Okay, so that leads us nicely into the last part of the show, and that is the US data last night. And you've mentioned the word stagflation to me off screen, and when I looked at it this morning when I woke up, it was one of the first words on my mind as well. GDP underperformed, but yet prices still appear to be rising quite strongly, and we do have the PCE data out tonight. Can you walk us through what inspired you to start mentioning that darkest of economic terms, stagflation, again from overnight? And can you give us some of your thoughts on the economic outlook for the US then, and what this sort of data series could mean for the dollar, for bonds and US stocks?
Yeah, sure. So if you look at from a perspective of the inflation data, so do not forget that inflation data tends to be lagging in nature. So what I'm monitoring over here is more on the break-even rates. So break-even rates is actually in US, is actually implied by the Treasury inflation protected yields. So it's a derivation from it's a derivation from there. So if you look at the 10-year and the 5-year break-even rates, that's been trending pretty much on the uptick since the start of this year, and right now they're actually hovering close. Let me immediately see the latest trend of the chart very quickly. Yeah, so they are hovering close to around that 2.4% to 2.5% level. So that's actually way above the inflationary target of the US Federal Reserve official desired level at 2%. So it actually implies to us that this ongoing, we call it stickiness about services inflation, is more or less related to the pretty much firm rising oil prices that has been going up about close to about 15% since the start of this year. And right now, dangerously, it's actually hovering close to the $90 US dollar per barrel mark. So that's actually looking at the current situation right now in terms of geopolitical risk tension. So there could be a risk of supply disruption and possibly of oil being used as a weapon of choice as for diplomacy purposes. So that could potentially see oil prices spiking to about $100 per barrel. So if that situation starts to take place, for sure, we slowly start to see lagging inflation data on a monthly basis, like the PCE or the typical usual CPI, inching slowly much higher above that 2.5% to 2.6%. So even you look at today's PCE number, the X-Core and X-Food, so market right now has started to revise a slight uptick to the expectation for today's core PCE price index on a year-on-year basis. So market right now is actually looking at around this 2.6% and 2.7% year-on-year. So that is almost very similar to the rate of 2.8% year-on-year printed in the month of February. So given this kind of consensus and with the US 10-year break-even and 5-year break-even inflation rates ticking up higher, that could actually put the US Federal Reserve in the tight spot of even looking to actually cut interest rate this year. So we do not forget that at the start of this year, we have this very strong Fed dovish pivot optimism to play. So that dovish pivot optimism has more or less been evaporated. So if markets were to be lucky to see at least one interest rate cut before the year ends, is considered as a very consolidation or pat in the back. There's a big risk that with higher interest rates staying at a longer period, that could put downside pressure on fixed income. What you see over here is that I think the US Treasury bonds prices has been inching down much lower for the three consecutive week. So we do believe that if this higher stickiness of inflationary pressure start creeping back to the US, bond prices may continue to face downside pressure as well. And now going forward on the major US stock indices, so it's being caught in between two opposite camps right now, because in the short term, we do have earnings announcement that is pretty much macro related. So anything that is pretty much optimistic on the AI side of the story, like what we experienced earlier on yesterday, where we start to see very strong rosy earnings numbers and guidance out for Alphabet and as well as Microsoft. We see the US benchmark stock indices overnight inching much higher, closing with the S&P futures and the Nasdaq 100 futures coming with a gain of positive 0.8% and positive 1% as we speak right now. And it's pretty much volatile, but on the other hand, the macro factor is actually not so rosy. Why? Because given the risk of the US Federal Reserve officials not fulfilling their dovish pivot narrative that markets hardly anticipated at the start of this year, that could lead to a further rise in the US 10-year Treasury yield, which has been pretty much firm after the break of that 4.5% level. So technically speaking, right, we're talking about the next significant medium-term resistance to watch will be at 5.2%. So if that scenario were to play out, it actually implies to us that we are now in a period of longer cost of funding. And with a longer cost of funding and that lackluster, we call it Q1 GDP flash data that was out yesterday, it could potentially seem to us that net profit margins on aggregate may seem to be challenged or being compressed on the downside given such a scenario were to take place. So I do believe that going forward, we may start to see quite a volatile movement on the major US stock indices, at least from a medium-term perspective. Given the fact that we are now facing conflicting factors. First one, macro side, but positive on the macro side. Right. Story.
Kelvin, thanks so much for your insights today.
My pleasure.
We've been speaking to Kelvin Wong, Senior Market Analyst at OANDA in Singapore, on BizTech's Asian Midday Market Watch. I'm Jeffrey Halley, and this video and podcast will be available on our website, www.biztech.asia, as well as our social media platforms. You can also catch it on our syndication partners, TV and radio stations and websites. Remember to like and subscribe. Have a wonderful weekend ahead, and thanks so much for tuning in today.